Welcome back, everyone, to another edition of Insightful Principles. My name is Kevin Jenkins. I'm here with a special guest, Greg Foss, and really excited to get this conversation started. And how's it going today, Greg? I'm glad you're here on the show.
It's great to be here. Looks like a solid day up here in Canada. I hope you guys are having the same.
Oh yes, Florida is it's always sunshine, so it's nice here this morning as well. So to get things started, can you share your background and experience for the audience?
Certainly. Well, first of all, thanks again for having me. I am. I always like to get this out of the bag. The first thing. I'm 58 years old, so I'm a boomer, and I like to think that I try and think outside the box from other boomers that have are making their voices heard, not always in the best way these days. So I'm 58 years old. I grew up in Montreal, Canada. I currently live just outside of Toronto, and I've spent 32 years trading in the financial markets. I like to say I'm a risk trader, but I focus on high yield bonds and credit as my area of expertise. So I started in Montreal as a engineer at McGill University, and that's important because engineers are pretty comfortable with mathematics, and that's my math is the base layer of language, Kevin. Doesn't matter whether you speak English or Spanish or Chinese. That's the second layer of language. Mathematics is the first layer. So everyone understands how to talk math and speak math, but their mother tongues may be different. So I always fall back to mathematics as an engineer, and I spent 4 years in engineering, but I knew I didn't really want to become a practicing engineer. And so in my fourth year, I applied to a school in the US for an MBA, and I had enough money to apply to one school in the US because it was pretty expensive even back then. It was $250 US per application. And as a starving student, I didn't have that much ability to apply, and I was lucky enough to apply to Cornell and got accepted at Cornell. I would not have been otherwise accepted as a U.S. citizen for the very simple reason that while my marks were good enough, I didn't have any work experience, and they were definitely looking for work experience. That being said, the trade-off was they were trying to build their international business school. And as a Canadian, out-of-country applicant, I slipped in under the radar, and I was one of the younger kids that was in the program. That was amazing because I got to experience from some of the older students in the program, but I also got to live with a bunch of undergrads at Cornell, so I experienced the U.S. Culture, vastly different from Canada. You think the two countries are really similar, but they're not until you spend a lot of time there. On a little side note, a sad side note, one of my roommates was actually killed in 9/11. So I always like to bring that up in memory of his family, and he was a first generation Irish immigrant to the United States. So anyway, experienced the U.S. culture, came back to Canada as I certainly could have worked on Wall Street. I had some opportunities, but I decided I wanted to come back to Canada. And my first job in Canada was working for Canada's largest financial institution called the Royal Bank of Canada. And I worked directly for the CFO on a number of very interesting projects. But that's how I got my start in the credit markets, was coming back to Canada, working for the Royal Bank of Canada. And I'm not sure, and this is our second take on this podcast, so I have to remember what I said yesterday or not, and it doesn't matter because no one will listen. But my first project, I discovered the Royal Bank of Canada was insolvent. And my God, you don't learn this stuff in school. How do you come and work for Canada's largest financial institution? And it was in dire financial straits because of a number of loans it had made to Latin American and other lesser developed countries called LDC debt, so lesser developed country debt, primarily Brazil, Mexico, Argentina in the South America. Nonetheless, Royal Bank of Canada was no different than any other money center bank in New York City. European global banks were in exactly the same situation. And it was because petrodollars were being recycled and lent to countries rather than companies. And these countries borrowed in US dollars, and the US dollar strengthened, and they couldn't make their interest payments. Now, for example, Royal Bank of Canada had about $4 billion. Doesn't sound like a big number in today's number, but in 1988, $4 billion was a big number, okay? Royal Bank of Canada had about $4 billion of LDC debt. And to make the math easy, the average trading price of the debt, while it didn't trade that much, was about 25 cents on the dollar. So if you do a mark-to-market calculation on that loan, Royal Bank of Canada had made $4 billion worth of loans at $1 per dollar, or 100 cents on the dollar. And those loans had fallen in price to 25 cents on the dollar. That would have meant Royal Bank of Canada would have had to write down or write off $3 billion of book value of equity to bring those loans to reflect the trading price. Well, if you went to the book value of equity of Royal Bank of Canada at the time, we didn't have $3 billion. It's unbelievable that the largest financial institution in Canada was insolvent in 1988. So that was my introduction to what I call the fiat Ponzi. Okay, how is it that bank depositors have comfort putting their deposits, and often way more than the FDIC or the CDIC, Canadian Deposit Insurance Corp, will insure them? They leave their money in the banks. Why? And you know the answer, Kev. Oh, they're too big to fail. The government will always bail them out. That's somewhat true because we've seen that over time. But the reality is, it's the fiat Ponzi. How would they do that? Well, they'll just print more money, okay? So in 1988, they had the Brady Plan. It was an ingenious plan that was actually accounting gimmickry that did not require the banks to write down the loans to market. Instead, the loan was changed from a 5-year obligation to a 30-year obligation. And it was the principal amount, the 25 cents on the dollar, was largely protected, if you will, by zero coupon U.S. Treasury debt that would accrete back to 100 cents on the dollar. It's pure mathematics. A zero coupon bond, over time, you buy it at 13 cents on the dollar, and over 30 years it goes back to 100 cents on the dollar. That's just the math of a 30-year zero coupon bond or strip bond. At the end of the day, it was an ingenious solution because the bonds actually did go back and at a time traded through 100 cents on the dollar as a function of interest rates and the changing credit quality of, at the time it was Mexico. But it was accounting gimmickry because the banks did not have to write their loans to market. Hence, they did not have to take the book value of equity hit. And the banking system, to an extent, was rescued. That was my first introduction to gimmickry, the socializing losses, if you will, on Wall Street. But over a period of 30 years, I've hit a couple of other pretty big icebergs, let's put it that way. 1999 was long-term capital management. 2008, 2009, we all know the unbelievable experience with the great financial crisis. And then in 2019, 2020, the COVID. And what happened in the great financial crisis in 2009, 2010, 2008, 2009 was all the financial risk in the system, the leverage in the financial system was transferred to the balance sheets of the central banks and the federal deficit. So, you know, again, it proves this fiat Ponzi. It proves the socializing of losses on Wall Street. It proves the leverage in the financial system. I'm certain that many of your listeners do not understand how the banking system actually works, but don't listen to Greg Foss. Listen to a famous American, Henry Ford, who over 100 years ago said, if the average American understood how the banking system actually worked, there'd be a revolution in the morning. And I actually believe that, okay? Because banks are absolutely astronomically levered to the risk they are taking. They hold very little equity capital compared to the amount of financial risk they are assuming. The world accepts it. It is leverage. The leverage in the system is a fact of life. The problem is when leverage gets taken out of the system, when people want their money back, they don't want that money deployed in equity markets, in hedge funds, in the banking system. That leverage unwind causes tremendous pain in the market. So we've seen that over time. And I'm going to arrive at the conclusion that you invited me on the show for. Fiat is the Ponzi. And in 2016, I found the solution. As everyone who first is introduced to Bitcoin thinks, oh my God, Bitcoin is the Ponzi. It's some sort of, and then you do some research, and I just could not believe the beauty of this technology. And it was the solution that I had been looking for, and I'm not kidding you, since 1988. Okay, that was my indoctrination in 1988 as to what the true risks are in the financial system and what the fiat Ponzi is.
Yeah, I know there's an author, his name is Edward Griffin. He created a book called The Creature of Jekyll Island, and he's discussing a lot of the things that you're talking about with how the Federal Reserve, the banking and the government system is all based off of debt, and people have to really understand how the banking system works. It's not really, if you don't understand how to leverage debt yourself, these banks are actually taking, your funds that you have in the bank and they're issuing it out. And the whole system is it's just crazy when you really think about how the government tends to get bailed out by the Fed and just everyone all around. So it is a Ponzi. When people talk about Bitcoin, it's like this is probably going to be the best solution that can help address a lot of the debt concerns that we have in just the banking system in general. But I wanted to transition. I really wanted to talk about credit and liquidity. I know you have such a profound background in credit. And as you mentioned before, credit really runs the economy. I just mentioned it with how banks and the government and the Fed work in tandem to issue out credit. But can you kind of describe how credit and liquidity stimulates the financial markets based on your experiences in the industry?
Okay, so that's a big question, and it's a really important and a very smart question. Okay, credit is a prior claim on any asset relative to equity. Okay, that's just finance 101. Remember that in the event of financial distress of a company or country, okay, now while a country doesn't have equity, the bondholders, unless the bondholders are made 100% whole on their investment, meaning if they lent $100 and they have a claim of $100 against that counterparty, unless the $100 is made whole, the value of the equity, which is a subordinate claim, is zero. Okay, that's just the way the laws and the courts have set up this capital structure. So you better understand what's going. If you're an equity holder in a company, you better understand what's going on in the debt stack of a company, right? Before you even consider investing in the equity. And unfortunately, many financial analysts on Wall Street don't even do that work. So it's not crazy for me to, or it's sometimes crazy for me to ask individual investors to do that work. But any portfolio manager, and there are lots of them, any portfolio manager who does not consider the value of the debt and where the debt is trading, given that they have an equity position, they actually shouldn't be managing money, okay? Because the debt markets always know when there's a problem. And the equity clowns frequently have no idea what's going on in the top of the stack. And the top of the stack, who are guys like me, can use the bottom of the stack as a hedge, meaning, let's say I'm long the bonds, and I think the bonds represent good value, so I'm not certain I want to sell them at a given price. But that being said, I'm not certain that they're going to recover their price back to parity or par. What can I do? I can hedge that uncertainty by shorting the common stock, either through put options or outright shorts. Or another instrument is called credit default swap market. But that being said, that's not a subordinate claim. The CDS ranks at the same level as the credit. So you can go down and you can short the equity. And a lot of times I've experienced this so often. What the heck's going on in our equity? I have no idea. Hey, knucklehead, look at the bonds. I will tell you what's going on in the equity because the bonds are shorting the stock to you because you are too stupid to understand that you have become now an option. Okay, the equity has become an option in the context of the capital structure because the bonds are uncertain as to whether they will recover full value. That's simple. You need to look at the credit markets. The credit markets are the dog. The equity is the tail. And that tail can get flung around like a rag doll when the bond markets and the credit markets have a problem. Take it one level higher with sovereign debt and the banking system. When the banking system starts to gurgle, meaning there's liquidity concerns, there's liquidity constraints, you'll see things like repo rates changing, the TED spread, the euro dollar to T-bill spread, which is a measure of stresses in the banking system. When that spread is widening, I promise you the equity markets are getting destroyed. And the guys are like, well, this is just a regular sell-off. And, this is good for the markets, a correction. If you guys do not understand what is causing this to happen, please get the heck out of equities because you shouldn't be managing risk, okay? That's simple.
Yeah, I know. I did some research about a couple weeks ago, and they were talking about there was a very big increase in reverse repos and just how the Fed is draining a lot of liquidity. So I think that you're absolutely right. You know, an investor can certainly look at the credit markets. They can look at the bond markets to kind of get details of what potentially is going to happen in the equity markets. And I wanted to also get your perspective on what are some indicators that investors should look for in the credit market to see what currently is happening in the economy.
So great question. I want to correct one thing. I'm not saying correct it, but just point something out. There's a difference between a repo market and a reverse repo market. And what's happened recently in the reverse repo market is that there's actually too much liquidity in the system as dictated by the reverse repo market. So that's not a telltale symptom of liquidity withdrawal. It's in fact a symptom of too much. The Fed has printed too much money. The Fed is actually stuffing more liquidity after liquidity and the banks don't want it and they're pushing back on it. So that was the reverse repo question. What should you look at again? What are some of the things? Okay, let's look at a simple thing you can watch. You can watch credit default swap spreads in indices. So there is a credit default swap index on high yield debt, for example. And there's a credit default swap index, and an index is just a compilation of 100 different names or whatever that trades on investment grade. Both of those are a good index to watch because as those spreads narrow, meaning that the concern over the default potential of that index of company has been reducing, okay, that indicates, hey, things are okay in the equity markets. Value will accrue to the equity market because the debt markets are not concerned that there is a prior claim issue. So watch CDS spreads in the various indices. I will take it up a notch and watch CDS spreads in sovereign debt is another example. Certainly CDS spreads in bank debt. That's a good one. And then if you want to look at, indicators that aren't related to any specific counterparty, but is indicated, LIBOR rates. Look at interbank offered rates and swap spreads in banks and the TED spread I already mentioned. A lot of these are, esoteric names for some of your listeners. But just understand that there are these markers and metrics that will indicate stress, even when the equity markets are like, I use the expression, it's not my expression, but, whistling by the graveyard. Oh, everything's fine. Everything's fine. Listen to Jim Cramer. He says everything's fine. So everything's got to be fine. Thank you, Jim.
Yes.
Now, I like Jim Cramer. Don't get me wrong, but even he has no clue what happens in the debt markets, okay? Like these guys are talking heads that just have no clue how the world really works. He actually has a clue. He just doesn't know which indicators to look for all the time.
Yeah, that's true. I think that with CNBC, They really are providing the marketing of securities, but they're not really going to give you the details of what actually is going on. So you have to actually take that time to do your own research
I
to
love
search
that. I
search for
love
those
that.
numbers.
The marketing, they are marketing securities. That is beautiful, man. I'm going to quote you on that. They are marketing securities. They're nothing but an advertisement for the equity markets. Very, very dangerous if you do not know how that works.
Exactly. So let's talk Bitcoin. So in your opinion, how do you feel that Bitcoin provides the best hedge within an investor portfolio in comparison to like gold?
Okay, great question. So the truth is that let's compare it to gold. What is gold? What is Bitcoin? What is real estate? They're all hard assets, okay? And each one has a varying degree of what I'll call hardness. And let's look at gold. So Bitcoin is frequently thought of as digital gold. On the one hand, I don't mind that comparison, but it's much better than digital gold. And then on the second hand, I like to think of it actually as digital energy, not digital gold. But we'll put that aside for a second. So what is gold? Gold's a 2,000-year-old element on the periodic table, okay? It's a store of value. Why? Because other people have accepted it as a store of value. It has developed a market in which gold has value. Why? And if you listen to Peter Schiff, who's a knucklehead, oh, it's because you use it for industrial purposes. No, full stop. The amount of gold that's used for industrial purposes and putting in teeth and jewelry is really pales in comparison to the gold that is held as a store of value. Okay, so I'm going to ask you. And gold generally grows at a fairly constant rate of about 2% annually. But herein lies the interesting question. What if the price of gold was to go from $1,800 an ounce, where it's currently trading, to $5,000 an ounce overnight for some reason? Do you think that supply rate of 2% per annum would stay constant at 2% per annum? Or would the smart miners of the world figure out how to get more gold out of the ground? Or, for example, could we get gold out of seawater where there are 20 million pounds of gold in seawater? We know how to do it. It's just environmentally catastrophic to get gold out of seawater. Point is, that supply rate of gold is not constant. You can argue that it's low and it has been growing at 2% annually, and I'm not going to argue with you. The difference, though, is it's not a certainty that supply rate is constant. Go to Bitcoin. What happens if the price of Bitcoin doubles overnight? Nothing. The supply rate of Bitcoin is written in math and code, and the total supply of Bitcoin will never exceed 21 million Bitcoin, ever. The hardest asset ever created by man is called Bitcoin, backed by a technology and a network of computers that's the most powerful computer network on Earth today. Okay? I sort of like that. Compared to gold, I like that type of certainty. Not to mention the fact that it's much more transferable than gold. It's much more identifiable or verifiable than gold. It's much easier to store than gold. It's much more divisible than gold. Long story short, Bitcoin is just so much better than gold. I still own some gold. But if I'm going to bet on a horse at a race, in the hard asset race, I'm going for Bitcoin. Okay? Paul Tudor Jones said the same thing. You bet on the fastest horse at the race. You don't only have to bet on one horse, though. You can go in a trifecta, right? You can own some gold, you can own some Bitcoin, you can own some real estate, and that's your trifecta that's going to win the battle of debasing currencies. Because a fiat currency is 100% certain to debase. That also is very seldom you find something like that in financial markets where you're 100% certain about something. Well, based on the debt spiral that all fiat countries have accumulated and find themselves in an ever-chasing environment, it is 100% certain that fiat currencies will continue to debase, and at this point at an accelerated rate. Okay? Dang. Those two things add up to me that I need hedges against this fiat currency debasement, and I'm going to be invested in hard assets. And in those hard assets, I'm going to pick the one that's best. And in my opinion, Bitcoin is the best. Not only is it the best, it actually is the cheapest right now of all three compared to where the price can go to. And that's what I always look for in a history of trading risk. I look at asymmetric return opportunities, and very simply, Bitcoin is the best asymmetric return opportunity I have seen in 32 years of trading risk.
Yeah, I think with Bitcoin, it really is going to tremendously transform the financial services industry. You know, just the blockchain itself is transparent, it's decentralized, where is removing us from such a centralized control system that we have with our Federal Reserve System. And people want that solution, and you understand that solution when you first did your research in it in 2016. And I wanted to talk on the price point of where you see Bitcoin going of $2 million, and how you really see it as an asymmetric risk asset. And also, do you feel that Bitcoin has an inverse correlation in comparison to stocks, bonds, or even commodities?
So yeah, you jumped. You are a very well prepared young man. So here we go. I'm gonna have to defend my $2 million price target, and I'm gonna get to that. Okay. I'm gonna also tell you that yes, I did get involved in Bitcoin in 2016. Okay. The price of which Bitcoin was less than $1,000 US a coin. Okay, so maybe I was early, maybe I was lucky, maybe I just happened to fall down the rabbit hole at the right time. But I will tell you, and I can look your camera right in the eyes right now, so I'm looking you guys right in the eyes. Bitcoin is actually a better risk return opportunity right now than it was when I got involved in it at a price of less than $1,000. I'm going to explain why that's the point. First of all, the system is 5 years older. It's been proven for another 5 years that the system has not been hacked. It has grown in strength. The price has gone up to reflect the number of people who are interested in this, but it's still a rounding error in the context of where I think it could go. So for example, when I got involved in it in 2016 at under $1,000, I could have probably, let's just assume I still had the same $2 million price target as to where I thought it was going to go. The chances of it getting there, though, in 2016 were substantially less than the chances of it getting there now. Even though the price has gone up 40-fold, it has a much higher probability of attaining my value. For what reason? Well, very simply because of COVID. Okay, COVID basically took the entire financial system and pulled forward 20 years of, I'll call it selfishness. I said at the outset, I'm a boomer, and the boomers may be the most selfish generation ever put on the earth. Okay, and I'm putting myself in that. We are so selfish that we can't even fathom a potential loss to our well-being and our comfort level, and we are pulling forward demand and pulling forward rewards at the expense of our children. Okay, it's disgraceful, but it's what gets politicians reelected for another 4 years. Okay, I am no fan of Joe Biden's. I am no fan of Justin Trudeau in Canada. I'm no fan of most politicians. They are absolutely selfish SOBs that are pulling forward future rewards at the expense of our children. That being said, it gets them elected for another 4 years, and Joe can wear his sunglasses and drive around in his car. I actually don't think he should be allowed to drive, but that's just my opinion on Mr. Biden. Okay? At the end of the day, and don't send me hate mail, you guys. I'm allowed to say that. It's still a free country, and I have no love lost for Justin Trudeau either. Okay? They're spineless squids. That's an aside. Let's go to let's talk about my price target of $2 million of Bitcoin. It's quite simple. I mentioned to you that I thought Bitcoin should be better described as digital energy, not digital gold. Okay? Why is that? Well, I'm an engineer. I always think of things in the laws of engineering. The first law of thermodynamics is the rule of conservation of energy. Bitcoin is digital energy, and you can think of that why? Because It takes energy to mine Bitcoin, to secure the blockchain. And think of energy as the input cost for Bitcoin, but also how Bitcoin is a bit like a battery that stores the value of energy over time and space. That's exactly what you look for in an ecosystem where the value of your work and time and energy expended today can be saved or stored for use in the future, and you don't want to lose that value. If you keep that value in fiat, we know what happens. If, for example, when I was 20 years old, one of my summer jobs was working on a hot roof, and putting shingles on a roof. Let me tell you, I might have earned $40 in a given extremely hot day when I was 20 years old. So 38 years ago, my God, 38 years ago, the $40 I earned, I promise you, is nowhere near the value of that $40 today, let alone the value that I had put into the house for improving the value of that house. My energy and time has been taken away from me by the fiat Ponzi over those 38 years. And if I went to spend that $40, do you think the value of my time and energy spent 38 years ago on that hot roof is reflected today? I could probably barely buy a lunch for myself at McDonald's even. I mean, most lunches cost 30 something bucks, okay? It's nuts. You think of how much energy and time I spent 38 years ago. The point is, Bitcoin is digital energy. It's a store of value. It's the most perfect store of value mankind has ever created. So in that context, I think that there is a chance that people who own valuable natural resource energy, like Russia, like Canada, would much rather get paid in Bitcoin than get paid in fiat. Think about that for a sec. Do you want digital energy for valuable natural resource energy rather than Ponzi fiat? I'd say 100%. So I think there's a very good chance within the next 10 years that energy becomes priced in Bitcoin. It'll start slowly. One country will do it. It doesn't particularly like the US. So Canada likes the US, but that other country that I mentioned doesn't really like the US, okay? So let's say it's Russia that starts accepting payment for their natural resource energy in Bitcoin. If Bitcoin becomes the standard of energy pricing, I believe that the US dollar is in danger of losing its status as reserve currency asset, not reserve currency, as world reserve asset, not world reserve currency. It can still be world reserve currency because fiats are still going to exist. But in terms of an asset, do not store your value in fiat. I've said that. Why? Because it's guaranteed to be debased. It's 100% certain. Anyway, back to the fact that in the world today, there are 900 trillion US dollars of assets. Okay, that includes global real estate, global bonds, global equities, fine art, gold, currencies, you name it. There's US dollar 900 trillion dollars of assets, financial assets. Is it crazy to think if energy is priced in Bitcoin that Bitcoin could attain a 5% share of that total addressable market of 900 trillion? And I don't think it's crazy, right, Kev? 5% of 900 trillion. So what is 5% of 900 trillion? 45 trillion. What is 45 trillion divided by 21 million? The answer is over $2 million of Bitcoin. Now, I can't be 100% certain it's going there, but I'm more certain it's going there today than I was 5 years ago. Hence, the expected value of my investment has increased. And I'll say it again, at this price, it's a rounding error in terms of the asymmetric return potential, or what in otherwise is defined as the right-hand side of the tail. Of the distribution, or the long tail. This is what I look for in managing risk. I look for long tail outcomes that are favorable for me. And I could run through an expected value problem. I don't remember if we did that yesterday or not. It's a moot point because nobody else heard it. But I could run through an expected value calculation that tells you why you should be buying Bitcoin with your eyes closed right now. Because anyone who owns 0 Bitcoin is actually taking a much higher risk than anybody who owns a proper portfolio allocation. And that gets to your final part of your question was, is Bitcoin correlated or non-correlated? Over a 12-year period, it's not a long enough time frame to determine that conclusively. But here's the reality. Firstly, Bitcoin has been the best performing financial asset over the last 10 years. You don't argue with that. Secondly, there are times where Bitcoin price goes down as risk-off trades are occurring, meaning equities are falling as well. But there's also times when Bitcoin is absolutely non-correlated to other global financial assets. I happen to think they will be over the long run. Why? Because Bitcoin is hedge against fiat currency shenanigans. Okay, Bitcoin is the anti-fiat. Bitcoin is like default insurance on a basket of currencies that you need to own because this other part of the equation is run so irresponsibly. Oh, well, we'll just print more money. Yeah, there's no problem. AOC. Oh, well, here's what we'll do. We'll print more money. You'd never print your way to prosperity. It is mathematically impossible to do that. Now, maybe she failed grade 11 math. And maybe you should call people out on that subject, but it sure helps to get them reelected when there's more money in people's bank accounts that are allowed to vote. Okay? And here's the final thing I want to mention, and this is really, the certainty of it. The only people that printing money actually helps are the top 1 or 5% of the population who own the assets that will at least keep pace with the money printing. So real estate, equities, hard assets, okay? Your house isn't actually going up in value, Kev. It's just that the unit of account is going down. So you're not making money on your house per se or making value on your house. It's just that it takes more of these debasing dollars to buy the same house, okay? Same thing with gold. Stock market returns measured in gold, real estate returns measured in gold show a vastly different performance outcome than measured in fiat currency. So you just have to remember what that fiat currency is. It's a unit of account that's 100% certain to debase.
Yeah, that's the number one reason why I feel that everyone should own Bitcoin is because it's really giving you a hedge against the debasement of the fiat currency, and the purchasing power of the dollar is only going to decrease. And I think it was such a great point when you mentioned that when the Fed and Powell, when they do tend to print more money, it's only of helping a lot of the people that already have these assets that accumulate in value, and a lot of the people that are in that lower to middle class that they only own some assets or not a lot. Inflation is hurting them a lot more than it is someone, a lot more wealthier. So I think a lot of this is financial education and just understanding what can you do to take control of your situation. I think Bitcoin is one of those best solutions that can allow you to overcome those challenges. So you kind of mentioned it earlier, but when we think about all of the bailouts that we tend to see the Fed provide, to the economy, when we think about quantitative easing, and also with inflation, how we have seen a rapid increase, and they come out with these terms that is transitory, that kind of diffuse the real situation of what actually is happening. Do you see any type of financial reset happening in the future?
So yes, I do. I can't tell you when, and I hope it's not tomorrow, okay? Because it's not going to be pretty, and I do not long for the day where the world is unraveling. I sort of love the world and living the world. The unfortunate thing is I see the dangers of it unraveling when these policies are invoked with little regard for our future. Again, it's a present value solution that costs our future an extreme amount. And so The reset is coming. Look, history is full of failed fiats. Voltaire famously said, I think it was 200 or 300 years ago, he said, all fiats fail. Okay, it will fail. Every single fiat will fail over time. It's just a question of who is first and who is last. And let's be honest, lots of fiats are failing right now. I mean, go no further than Venezuela. And the citizens of Venezuela are the prisoners of that. They are not the beneficiaries of that. And, the privilege to live in G7 countries like Canada and the US, we don't tend to think about it. It doesn't hit home, but I promise you it hits home with the citizens of those other less privileged nations, okay? And a lot of it is because of bad policies. A lot of it is because of bad dictators. I'm not going to defend any of that stuff. I'm just going to say that there's a reset coming. Why? Because it always comes. Okay, I'm 58 years old, but let's not forget how old civilization is. It's, we are just one epoch. Now, there will be 10 years, in the next 10 years, there will be 100 years worth of change, in my opinion. Okay, the amount of things that have happened since 1921 versus 2021, you're going to see that amount of change happen between 2021 and 2031, in my opinion. Okay, and you need to be prepared for it. You need to be hedged against it. You need to benefit from it. And again, it's the people at the lower end of the spectrum, not just in lesser developed countries, but also in North America, right? Like we have the population that's getting hurt the most in North America is those that don't have the financial assets that will accrete in value with the debasing of the currency. Most Canadians and most Americans live essentially paycheck to paycheck, okay? If they have any savings, it might be $10,000 in the bank. And we know what that's happening to that $10,000. It's being debased. It's being stolen from you. But if the government gives you another $1,000 and you only have $10,000 saved up, your first reaction is, oh, thank God the government gave me another $1,000. The reality is, though, that $1,000 is stealing from the $10,000 you already have saved up. It just becomes like a Pac-Man that just chews away at the store of value that you have spent your valuable time and energy trying to accumulate. They're stealing it from you. Okay, and when I say they, the system, okay, it's the same everywhere. It's not like it's one group of nefarious people. It's just the way that it works. And you got to hedge yourself against that, listeners. You have to, okay? I hate to say it, but it's only math, okay? You got to hedge yourself against that certainty.
Yeah, I certainly agree. And I wanted to talk about asset allocation and kind of get, your viewpoint of how do what will you tell someone that doesn't own any Bitcoin as far as how much they should allocate for it? And then also, if they're looking at other categories such as equities, what would you kind of, advise that you've done in the past that you could recommend to someone?
All right. Thank you for that law ball of a question, okay? So I've traded bonds for 30 years. I currently own no bonds. And it's my opinion that anyone that owns bonds right now, any type of bond, is an absolute idiot, okay? It's only math. That being said, lots of pension funds have a mandate that they need to own a certain amount of bonds. That's an inefficiency that needs to be overcome. Mathematically, though, when I started trading, the US 10-year was trading at double digits. High yield was at 15%, 15%. Now that's high yield, okay? And currently high yield is 4%, and the US 10-year is 1.25%. You don't make something out of nothing. A bond is only a fiat contract that will pay you that 1.25% over 10 years with almost certainty. The problem is, if you lend the government $100 today, you get 1.25% coupon, meaning you get $1.25 on that $100 each year for 10 years. And then in 10 years, you're most likely going to get your $100 back. It's not certain. There's a very low probability, but it's not zero that the U.S. Treasury doesn't make that payment. The problem is, in 10 years, the $100 that you lent today is probably worth 65 bucks. Plus you only, in purchasing power, plus you only got $1.25 per annum, which is actually lower than the rate of inflation, even though the CPI basket has been manipulated to remove things that make it look much higher, much lower than it should be. For example, a long time ago, CPI used to include house prices, but they've conveniently removed house prices from the CPI so that, you know, the reflection of increasing value of your house is no longer in that basket. Okay, so the point is, bonds are a horrible investment from a destruction of value perspective, and high yield is no better, because 4% before you account for expected and unexpected default losses, it's just a dumb investment. So I own 0 bonds. The proper allocation to, and I'm saying anyone who does, is either mandated or doesn't understand mathematics, because there are no capital gains in bonds. Okay, bonds are a fiat contract, mathematical. There is nothing, you don't get something for nothing in bonds. In equities, many times you do, because value accretes to equities. The uncertainty of a company accretes to an equity holder, not to a bond holder. Uncertainty being the upside. There's also the downside. We talked about that before. But remember what a bond is, and do not own 40% of your portfolio in bonds. That is absolute stupidity. But moving on. Bitcoin. You got to get more than 0. I've already told you that. You got to get more than 0 and less than something, because I'm not telling you to put 100% of your portfolio in Bitcoin. Again, if you own 0 Bitcoin, though, you're taking more risk than if you have a proper portfolio allocation. What is that proper allocation? Well, according to Yale University, the proper allocation for Bitcoin, for a portfolio that has exposure to a diverse set of assets, is between 6 and 8%. They also say that that allocation should come from your bond holding position. Okay, but until you get to 6 to 8% of your overall portfolio allocation, don't think about it. Get to that allocation, and once you're there, you can text me or listen to anybody else who you know, I own more than 8%, but I don't own 100%. And why is that? Well, because you can never be as certain about anything in the investing world. Again, the one thing I am certain about is that fiat currencies will continue to debase. That's a certainty, so you build your portfolio off that. But I can't guarantee you that Bitcoin is going to be the winner. I'm highly confident it is, but I can't be 100% certain. So those are the risk perspectives that you need to weigh. Again, it's not me, it's not Greg Foss, it is Yale University saying every portfolio should have between 6 and 8% weighting in Bitcoin. I'm not going to argue with them. I think that it feels proper to my gut. And sometimes you go with your gut when you're managing risk, because risk happens fast. Okay, risk is what happens when the world unravels, and when everyone is confident and the perception of risk is low, meaning equity prices are high and volatility is low, actual risk is extreme. Okay, once again, when perception of risk is low, actual risk is high. And the flip side is when things are getting destroyed and equities are getting tossed out, and the S&P hit 666 on that famous day in March 2009, the perception of risk was absolutely off the charts, but actual risk was pretty damn low. Like, in hindsight, it proves that if you did buy the S&P at 666 that day, you've made a good risk-adjusted trade. So always remember that the perception of risk and actual risk are two very different things. So just get yourselves off 0, own some Bitcoin, own it in various capacities, and just put that portfolio allocation in there. And the funny thing is, if people do get to 5% of their portfolio, Kev, what's the portion of their portfolio they lock onto and absolutely are like, oh my God, it's that silly 5%. It's not the other 95% of their portfolio that they're used to being invested in. It's this new 5%. And you got to move that out of your entire, your paradigm as well. Yes, it's a volatile asset, but volatility is the price of return. Very rarely do you get something that has really good returns if it's not volatile. Amazon stock is no different, okay? Over time, the smartest thing you could ever have done is bought Amazon stock and hodled it forever. But there's only one guy that did that, and that's Jeff Bezos. Perhaps his mom. Okay, so Jeff Bezos and his mom were the only people that have hodled Amazon stock from time zero till now. Everyone else was a genius, and they were trading it. And stop. Get your allocation, and then we will talk.
Yeah, I think the buy and hold is the taking away point. It's just holding it and not really worrying about it. You know, we understand what's going on in the economy, and it's not about overthinking it, but just being smart about it and holding it for the long term. So you kind of talked about it briefly about how you own Bitcoin in various different ways. Would love to hear your opinion on how you view just holding it, whether it's a hot wallet when you have your own actual wallet that's connected to the internet, or any different cold storage methods with off the network, and also tax advantage accounts. I know in Canada you all actually have Bitcoin ETFs. We're still working on that here in North America, but I'm sure we'll be coming along very soon. But we'd love to hear your opinion on that as well.
Yeah, so I own Bitcoin on three separate, call them channels. Okay, I need people to understand the beauty of the Bitcoin technology by holding it on their wallet and being able to transfer value from an iPhone or a mobile phone to another mobile phone or a Bitcoin address anywhere in the world. It's absolutely beautiful. It's the ability to settle a trade of value in 10 minutes anywhere in the world, i.e., I can send Bitcoin, and I have, to an indigenous tribe in New Zealand, for example. Okay, if I sent, it wasn't a huge amount, but it was big enough that it mattered to me and to them. I sent that value across the world, and it settled in 10 minutes to a Bitcoin address that, you know, I didn't need a bank wire. I didn't need to jump through the hoops that a bank would require me to. When you go and send money internationally in a bank, it's a very painful process. Very, very, very painful. So there's that convenience factor. It shows you how the technology works. But I wouldn't store, or, a different way of storing, I wouldn't store my large Bitcoin holdings on my iPhone, because why? It's not that the Bitcoin blockchain can be hacked, and it can, but it hasn't been, and I'm highly confident it will never be. But what I am worried about is people either losing their iPhone or their iPhone getting hacked. Okay, now you can lose your iPhone but not lose your Bitcoin, but people tend to get sloppy on those things. All right. So don't keep too much of your Bitcoin on a hot wallet, but understand the beauty of that technology. And if you've accumulated Bitcoin on your hot wallet, and let's say you bought some at $100 and now it's trading at 40,000, well, you're probably smart to take that 40,000 and move it into cold storage. Okay, what does cold storage mean? Well, you mentioned it. It's not connected to the internet. It basically transfers the Bitcoin that's held on your hot wallet or your iPhone to a ledger, and you take that. It's off the internet. It cannot be hacked because it's not connected to the internet, and you put it in a safe or something for safekeeping. Okay, that's like storing your gold bars in a safe for safekeeping. And then the third way that I own Bitcoin, and I do live in Canada, and I was a founding shareholder of one of the companies that did bring Bitcoin closed-end funds to the Toronto Stock Exchange, which were the precursor to Bitcoin ETFs, which Canada has, and it's very valuable for the investing community in Canada to have these things, because we can put those ETFs into tax-advantaged Canadian funds where the government is essentially paying us to own these assets. And I like that. So I can buy 50% more of these assets because I don't have to, I'm using the equivalent of after-tax dollars that the government's not taxing. So I own it in all three ways. Does the US get a Bitcoin ETF? My thinking is yes as well, and there's a lot of really qualified applicants in the queue, but they're dragging their feet as the politicians are apt to do. But a Bitcoin ETF really works in Canada. It's a very good solution to some of the problems closed-end funds have. And down south, there's one called GBTC, which is the Grayscale Investment Trust in the US, which currently trades actually at a discount to net asset value, meaning the value of Bitcoin that you're getting exposure to is not properly reflected in the price of the individual GBTC units. So yes, full disclosure, I do own some of that just because I'm getting 100 cents for 90 cents. And I typically enjoy purchasing something at a discount to net asset value. The problem is I cannot put GBTC in my tax advantage accounts in Canada. It does not qualify. And for the US listeners, GBTC does not trade on the New York or NASDAQ. It trades on what's called the pink sheets, which is it's a non-regulated exchange. There are problems with that, but the reality is it's still a $30 billion fund. Okay, $30 billion. This is really amazing. And it trades at a 10% discount to its net asset value, meaning there's a $3 billion delta there between the amount of Bitcoin that's held by the fund and what the market is willing to pay for the fund. So yeah, I do own a little bit of GBTC as well. And that's sort of in my blood because I've been a trader for so long. I will trade one against the other, but I'll always have my core position. I always have a core position of Bitcoin. That will never change.
That's so great to hear. And the last thing that I wanted to ask is, I know that you're the executive director for strategic initiatives for Validus Power Corporation. Would love to hear your thoughts on what you all are doing as far as with Bitcoin mining, how they actually help with that, and also how you plan to actually utilize Bitcoin to consume energy waste.
Great. Well, thanks for bringing that up. So Validus is a really cool company. It's a private company in Canada with 20 years of over 20 years of experience in the energy and electricity markets globally. We focus on Canada, and my business partners reached out to me because they realized that Bitcoin mining was becoming the marginal consumer of energy globally, right? And that's a good thing because it actually makes the electricity grid more stable. A lot of people won't understand this, and then you get a lot of the environmentalists that don't even understand how the electricity grid works, and they think that Bitcoin's boiling the oceans, and but it's fine when they drive to work in their car, and as long as they're using a Tesla, everything's good. They just don't understand how the energy grid works, okay? But let's just assume that these people, if they actually did one iota of homework, they would realize that electrons have no idea whether they're generated through coal or hydroelectric or nat gas. If they're powering their Tesla and it's being the Tesla battery is being charged using coal, are they really that environmentally just green? Because they are, even by their own definition, they're, coal is evil, but hydroelectricity is good. Well, I'll even take it one step further. My business partner happens to be Indigenous Canadian, meaning the lands that are flooded when you build a hydroelectric dam in northern Canada, that's not that environmentally friendly to them. I mean, they just lost huge amounts of land because you've decided to dam up a river. And, but going forward, it's environmentally good because, rainwater will refill the dam naturally. Okay, all true, except you got to start, you can't be hypocritical. You got to understand all that. But let's just assume that hydroelectricity is green and coal is evil and natural gas is somewhere in between. I happen to believe natural gas is the most perfect solution to the energy problem, with the exception of nuclear. Nuclear is absolutely the best, but God forbid an environmentalist should ever embrace nuclear power. I mean, it's just like it's antithesis for them. So what does Validus Power do? Validus Power is an energy company or an electricity company that takes natural gas and runs it through a jet engine, essentially a turbine. And that turbine generates electricity. And that electricity can be used for anything from industrial uses to powering a data center to Bitcoin mining. And that natural gas can come from a pipeline, or it can come right from the ground as a very sweet product, meaning there's no byproducts in it that could gum up your turbine, or it can come from the ground and it needs to be cleansed to run through the turbine. Now, typically the natural gas that comes from the ground that is dirty gets flared. You see these pictures where you have a pump jack in an oil field, and they're pumping the oil out, and the natural gas is also coming out of the ground because the two tend to reside in the same in the same chambers. The natural gas that's being flared is dirty natural gas generally, and it's also being flared into the environment and creating carbon dioxide and heating, and there's heat that's generated. So we can actually take that flare gas and we can use it to mine Bitcoin. Now that's pretty cool because you're also cleaning the environment at the same time. You're creating a revenue stream. And here's the kicker, Kev. This is even the more important part. Imagine if the grid got to capacity, which it does on a fairly regular basis. Only about 8 to 10 days of the year does the grid get stressed. But instead of mining Bitcoin with that excess flare gas, you flick a switch and it goes into the grid. And it helps to stabilize the grid. And it avoids the calamity like what happened in Texas earlier this year, where the grid was stressed and there were rolling brownouts. And if you read some of the research, it was within literally hours of the entire grid collapsing. Now, people really died. There were people who died. There was a tremendous amount of stress in each household that wasn't able to heat the household and everything like that. Point is, Bitcoin mining is not environmentally catastrophic like all these anti-coiners would say it is. In fact, it's the reverse. It helps to stabilize the grid. It creates revenue sources from otherwise wasted energy. Okay, and most importantly, and this is the one that I need to focus on right now, people will say the entire Bitcoin network consumes more energy than the city of New York. And I'll say you're right. But the difference is Bitcoin is changing the lives of billions of people that do not live in the city of New York. And secondly, on a total consumption basis, Bitcoin energy use is only 1/2 of 1% of the total energy produced annually by the world. If you're that concerned about 0.5%, I suggest you focus on the other 99.5% of the world energy, and you'll find a lot more things you should clean up before you worry and focus on Bitcoin energy, okay? And then there's another study that actually says it's not just 0.5%, it's actually 1/10 of 1%, but I don't even need to go there. The math is the same. Focus on the 99.9% of the stuff that we're all already doing wrong, rather than the 0.1% that's going to change the world for literally billions of people who still do not have a bank account. Don't tell me in your beautiful wrap yourself in the ESG and I'm here to save the world that you shouldn't be helping 2 billion unbanked citizens of the world get access to a store of value that will change their lives. If you do tell me that, I'm going to look you in the eyes and say you're the biggest hypocrite I've ever met. And most of them are.
Yeah, I think that everything that Validus Power Corporation is doing is very necessary. With just changing the mainstream media when they come out with these environmental concerns with Bitcoin, it actually does a lot more good than it does bad. And I think that to what they're doing with consuming the energy waste, it's amazing to see what you all are doing. So definitely keep up the great work. And Greg, I did want to say thank you so much. This was a great conversation. How can the audience either connect with you, either online or either learning more about Validus Power Corporation?
Well, I'm going to tell you, thank you for having me a second time, right, Kev? We've done this twice. This is good. I think this one was actually better than the first one. I don't know, but if this one was, then there's a reason that this one is the one that'll make it off the cutting room floor, right? The tape. But so for Validus Power, you can see our beautiful technology at validuspower.com. Okay, so just go to the webpage VALIDUS power.com. And incidentally, our stuff is manufactured in Texas, so we do have a very fond link with the great state of Texas. Okay, so that's validuspower.com. If you want to follow, if you haven't had enough of me today, you can follow me on Twitter. I tend to yell a lot because I care. On Twitter, I'm at Foss, Greg Foss, so FOSS, GREG FOSS. I'm 58 years old. I warn you, I don't understand all the beauty of Twitter, and sometimes I break the rules, but I'm okay with that because you need to call out the criminals of Twitter, like Steve Hanke. Okay, Steve Hanke's a professor at Johns Hopkins University. That man deserves to be absolutely vilified for his poor takes on not only he's happy that the world suffers under fiat abuse, and yet he won't embrace the most beautiful solution to that. And just for follower count, he tends to throw shade at the Bitcoin world. I have a big problem with that, and I will call him out. And if that offends you, well, then don't follow me on Twitter, because I call out the what I view as the criminal intent, and I say that sincerely. There are certain people that are so conflicted that it's disgraceful that they still have a podium, but a lot of people listen to that. So that's me on Twitter. Follow me or just text. I can't say text me, but
And just want to tell everyone, thank you for tuning in to another episode, and we'll see you next time.